So, hello
Okay.
everyone. Welcome, Angelo. Um, Tonight is a big night for market timers because we received many new subscribers, mainly from Czech Republic. Many of them are intermediate or starting investors, beginners, and I think they will appreciate a lot if you can give them some insights about inflation and current economic situation. So I know you always speak slow and very articulate, so this is good. So people will understand you.
Sure. Hey, everybody. Well, uh, good afternoon. It's 2:30 here in New York, so that's all that matters to me. It's hot and humid. But I wanted to go over with everyone how the BLS, the Bureau of Labor Statistics, calculates inflation. Now, this is not their forecast of inflation or my forecast of inflation. Okay. The Bureau of Labor Statistics has a mechanical methodology, a sliding window, if you will, of a 12-month rolling period year over year that they use to average out inflation. And then that's the percentage increase that they report to us. So the first step is the BLS calculates all of the inflation components, tallies it all up, and then they use this second step to report it. But this reporting methodology it's a mechanical methodology whereby you have a 12-month rolling period, and each new monthly data point or increase or decrease that comes out, the 12th month or the 13th month drops off from the back. And what it does is it causes a recalculation of the average inflation rate for that 12-month period. So you'll understand what I'm talking about in a moment. So here's what I want everyone to do. I didn't have time to replicate this particular chart, but if you would grab a pen and maybe a piece of paper, 8.5 by 11, something like this, okay? And I'm going to show you what I want you to draw. Okay, I want you, if you can see that, I want you to draw an upward sloping line basically to the middle of the page. Okay, I want you to do that. And then I'm going to want you to do these next 3 steps. Okay, can you all see the rest of that? I want you to draw dots declining. I want you to draw dots flatlining. And then I want you to draw some dots upward sloping. And you're going to see why in a moment. Okay, and this will help you visualize exactly what I'm talking about. And then when we're done going over this, then we can actually talk about our forecasts for inflation. Okay, but right now, this is simply the mechanical process for the way the BLS calculates month over month changes in inflation. Okay, so the first step here is I got this data. I didn't come up with this data, but I got this data from a firm called Research Affiliates. Okay. So one of the things that they showed was if inflation were to be 0% inflation every month from now until the end of the year, okay, 0% month over month inflation every month between now and the end of the year, that number mathematically would be 6.3%. So you know your downward sloping line? I want you to write 6.3% there. So basically like that. So you're going to write 6.3% at the downward sloping line. Okay? Now, the next step is the horizontal dotted line, meaning a continuation of your solid line. The next analysis that research affiliates did was
Order partially filled.
they took
Order filled.
the previous 12 months,
Order cancelled.
which, if you all remember, back in July, it was an 8.5% inflation number. Well, if you take 8.5%, use your calculator, if you take 8.5%, 8.5, and you divide it by 12, right, because that's the 12-month rolling period, you divide it by 12, that means inflation would finish the year at 8.5%. Okay? The third step that research affiliates did is they said, you know what? We're going to take the 3-year average of inflation for the past 3 years. So that would include like 2019. It would include the deflation
Order
of
partially filled.
2020, and
Order
it would
filled.
include the inflation of 2021. And when you do that, that number worked out to be, just bear with me 1 second. Oh no, I'm sorry. I'm going to back up. If you take the 8.5 and you divide it by 12, you get 0.7. Okay? So if you take 0.7% monthly increases between now and the end of the year, I'm sorry, it's not 8.5, it's 10%. Okay, so if you take the average of our current inflation rate, which is 0.7% per month, and carry that out to the end of the year, that number works out to be 10%. So that's your top number. That's your top number. Okay. Now the average of the last
Order
3 years,
partially filled.
the average
Order
of the
filled.
last 3 years, which was 2019,
Order
2020, and 2021, the average monthly inflation rate of that 3-year period was 0.3%. Okay, that 0.3% is what gives you the 8.5%. All right. So this is the mechanical methodology that the BLS uses to come up with inflation. It doesn't speak at all to the components of inflation, such as used car prices, new car prices, gasoline prices, owner's equivalent rent, food at home. It doesn't speak to any of that. This is simply after the BLS takes all of those components, tallies it up, and then plots it on this 12-month rolling chart. Here's what's really interesting. At 0% inflation, what we can do is 6.3% inflation. And that assumes no more inflation between now and the end of the year. All right. And here's the crazy part. Wall Street thinks that for the calendar year 2022, Wall Street thinks that inflation is going to come in somewhere between 4 and 6%. They're nuts because inflation is going to continue to percolate between now and the end of the year. There's no way we're going to have 0% inflation month over month between now and the end of the year. The reason research affiliates did this was just to be able to show the absurdity of all of this talk that, well, if the markets get really bad, the Fed will back off, the Fed will pivot. Well, excuse me, but all of this talk about the Fed backing off on raising interest rates is for the September Fed meeting. These numbers that we're talking about here are through the end of the year. So there's a timing mismatch. There is no way inflation's going to be 6.3% between now and September when the Fed meets in the third week of September. Okay? So when you think about this framework and you take it and you overlay it onto whatever other work you're doing with respect to inflation, as I have done, and as I'm sure David's thinking about it right now, one of the other models that David and I use, now this is a forecast of inflation. It doesn't think that these particular models that David and I use, and Pete, these models don't see inflation going below 7% until sometime next year into 2023.
Those are nowcasting models, not forecasting, nowcasting.
Yeah. Okay. Well, they are.
They can change, in a month they can change because they are nowcasting.
Absolutely. Okay. But right now, those nowcasts don't see inflation below 7% until sometime in 2023. Now, if any of you were watching the price action of the dollar, the euro, U.S. stocks, the U.S. bond market at the open this morning, you will have noticed that the market started to rally. The dollar had a big drop, the euro rallied, and then everything has reversed. And now the dollar is back up, the euro is back down a little bit. Stocks, they're in no man's land right now. Why am I bringing that up? Because Wall Street has this idea in its head that the Fed is somehow going to be able to back off and stop raising interest rates. Well, I have a news flash for the people that are thinking in terms of that narrative, and that's what we call that kind of talk. It's just a narrative that's not based in any kind of facts or data. And the point there is that if the Fed does stop raising rates, and with 0% inflation, and that gives us 6.3 through the end of the year, what do you think inflation's going to do if the Fed stops raising rates? Other components in the nowcast for inflation are going to start to put upward pressure on inflation, and inflation won't be able to come down. So, I keep telling people, that anyone that'll listen, this is not 2019 when we had 2% average inflation. This is not 2019 or the fourth quarter of 2018 when the Federal Reserve decided in January of 2019 that they were going to back off. They were able to back off because there wasn't any inflation. This time around, we have lots of inflation, and it's even worse in Europe, I think, than it is here in the United States. So, having said all of that, I want to talk about one important component of inflation here in the U.S. And it's actually, at the moment, it's the largest weighting in headline inflation, and that is something called owner's equivalent rent, OER. What is that? Well, let's back up. In the 1980s, the Bureau of Labor Statistics, they used to measure actual home prices. And they would use actual home price inflation in their calculation for the inflation rate. Well, the problem is home price inflation and inflation in general got so bad that it drove inflation up to 14.7% in March of 1980. Well, guess what? The BLS freaked out. And they decided, you know what? We need to come up with another way to measure home price inflation. And what did they come up with? They came up with this idea, or this methodology called owner's equivalent rent. So what is it? It's a survey that the Labor Department sends out, or they call homeowners. and they ask homeowners, how much do you think you could rent your house for? And so I might say, well, David's laughing, but this is
This is
actually what,
a fucking parody.
okay, this is what they do, David. So they call homeowners. They say, hey, David, how much can you rent your house for? And David goes, I don't know, $4,000 a month. Okay. Following year, they, they call up David and they say, David, what do you think you could
Order
rent your
filled.
home for this year? And David says, well, I know housing prices have gone up, so I could probably get a little bit more rent. So maybe $4,100. Okay. Meanwhile, home prices actually rose 10%. And David's going, yeah, I think I can get 4,100. Well, what's the percentage increase between 4,000 and 4,100? Um, Not much, 2%,
Two and a
right?
half.
2.5. Okay, 2.5. But home prices went up 10, right? Now, in the third year, David gets a phone call again. David, what do you think you could rent your house for now? Now, mind you, at this point, housing prices are up 20%. And David says, well, I can probably get 4,500. Well, you can see the problem here. It's a survey based upon a homeowner's opinion about what he thinks he could get in rent. Now, the homeowner's opinion and the actual facts of how much home prices are going up are two big and different things. So what's happening here is that home prices are going up a hell of a lot faster and higher than the homeowner survey is keeping pace. Yet this is the piece, the survey piece, that the BLS uses in one of their inflation inputs when they calculate headline inflation. What's the problem with that? The homeowner survey operates on a severe lag to actual home price inflation. So, what does that mean going forward? And for us, here in the U.S., let's say, between now and the end of the year. Between now and the end of the year, the owner's equivalent rent component of headline inflation is going to continue to accelerate to the upside. And mind you, it's the biggest weighting in headline inflation. It's somewhere between 20 and 30% of total headline inflation. But other components of inflation, like I said, are used car prices, new car prices, food at home. In other words, you go to the grocery store, right? Those prices aren't going down.
Order partially filled.
They're staying the same
Order
or they're
filled.
continuing to go up. So remember that 8.5% number, that middle number we came up with? Remember, that was simply a 3-year average of the monthly inflation rate. So if inflation does nothing but continue doing what it's doing, doesn't have to go up, it doesn't have to go down, inflation is going to end up at 8.5%. Does anybody in their right mind think that the Fed is going to be able to cut interest rates or back off of quantitative tightening with inflation running in the 8% range? Me personally, I don't think so. And my personal, investment strategy is to continue to position for a stronger dollar because the Fed's not going to be able to back off. Position for a weaker euro, weaker pounds. I really don't know what energy is going to do between now and the end of the year. I'm just going to guess that it'll probably get a little bit stronger. So I thought that having this discussion about how the mechanics of inflation work were really important because it gives us this band of 6.3 to maybe 10% on the upside, right? And when we start to have a discussion about that band, it becomes very obvious that inflation's not going to decline very much, if at all, anytime soon. And with that, I'll open it up to maybe some questions.
Yeah,
Oh, you know
maybe
what?
before questions, I would add a little bit on Europe, right? Um, this is German PPI. So these are producer price index, and this is from last week. And year over year, July is plus 30 fucking 7%. Month over month is 5.3%. Month over fucking month. So and this is a leading indicator. So when PPI goes up, the CPI goes up next month, right? Or in next 1 or 2 to 3 months. So in Europe, inflation is going up. Natural gas just doubled, like the European natural gas is, it's fucked up. Seriously. So in Europe, Germans will get such high inflation that in my opinion, it will cause social instability. And we have October coming. And remember, historically, October is a month of social unrest, of revolutions, of stuff like this. So think about it. What can happen in October, maybe November, when people will start getting not only pissed off about inflation, and they have Weimar Republic still in their memory. Their parents and grandparents are telling them stories that they didn't forget. Oh no, fucking way! Germans don't forget. The militarists in Germany are already getting money. They are getting funded. They are getting to the power. So we will see, and this is what the euro-dollar pair, currency pair, is pricing in. It's gonna be fucking ugly here, and we don't know yet what is going to be. Is the euro currency union is going to fall apart? Is there going to be another important exit from European Union? I have no idea, but this is not something nice. And if you have your life savings denominated in euro, you better think that you cannot have all your savings in fucking euro on a fucking bank account. It's just that's just pure madness. For example, a lot of my my capital is in the United States. It's not even in a European bank. A lot of it is in dollars. Some of it is in gold. So you need to. So before you start thinking about stocks and Tesla and whatever, you need to think about what currency is your savings denominated in. Okay, it's very important.
Yep. And David, since you brought up European inflation and whatnot, let me just talk about the ECB for a moment, and let me talk about the U.S. Fed for a moment. So, as most of you are probably aware, there's something called quantitative tightening. And all that is the US Fed allowing all of the security purchases they made over the last 15 years, which is roughly $9 trillion of US treasuries, treasury bills, notes, and bonds sitting on the Federal Reserve's balance sheet. The Federal Reserve is currently allowing roughly 45 billion a month to mature and roll off, and the Fed is no longer replacing them. So the idea here is that over a long period of time, the size of the Fed's balance sheet will begin to decline. Now, in 2 weeks, on September 1st, that 45 billion is going to go to 90 billion. Well, if you take 90 billion times 12 months,
filled.
that means that the Fed is on a track to reduce its balance sheet by roughly $1.1 trillion a year. Now, there's a problem. The combination of the Fed raising interest rates, raising the Fed funds rate, and allowing these treasuries to roll off its balance sheet,
Order
it's
partially filled.
causing something that we
Order
call
filled.
credit conditions are tightening. It's causing credit conditions to tighten. What does that mean? It means that it's causing a stronger dollar, which then puts pressure on the European Union. It puts pressure on emerging market currencies, and it basically creates a shortage of dollars
Yeah, so
around
I
the
would add
globe.
to this, Angelo. Uh, I don't know if people realize or understand that most of the debt in the entire planet, majority of debt, you know, be it corporate bonds, government bonds, most of debt on the globe is denominated in dollars. So governments, companies all around the globe owe money in US dollars. So when dollar is going up, then they have to pay up in dollar, and dollar is more expensive. So if dollar is 14% more expensive, your debt is suddenly 14% bigger. And now the interest rate is increasing on your fucking US denominated debt. It's not like you are still paying 2% or something like that. No. You are paying 8%. If you are some company in Thailand, you probably will be paying what 17%, right?
Yep.
So when dollar goes up, something is wrong in the kind of the offshore. Not only in the it might not be only the American banking system, but it can be the global
Banking system.
banking system. The kind of the red dollar, the dollar that is outside of the United States, right? Which is a huge
Yep.
thing.
So that is all a part of this thing that we call tightening credit conditions. Now, someone that I speak to a lot thinks that the Fed needs to start thinking about the repercussions of quantitative tightening on current credit conditions. Now, I said to him, I said, well, what does that mean? Are you suggesting that the Fed needs to start thinking about stopping quantitative tightening? And the reason for that line of thinking is because quantitative tightening is is another form of, I call it a phantom interest rate increase. So you have the Fed raising Fed funds rates, but at the same time, when you are reducing the size of the Fed's balance sheet, that reduction in liquidity causes, and nobody knows what the real number is, but it causes some sort of additional tightening in the system. So we call it a phantom interest rate increase. Is it 0.5%? Is it 1%? Is it 2%? We don't really know, other than quantitative
Order
tightening
partially filled.
uh,
Order
in and
filled.
of itself
Order
is a
cancelled.
form of interest rate increase. We just can't measure it because nobody knows. So the Fed is doing what we call this double shotgun approach. They're raising interest rates and they're implementing quantitative tightening. And that's causing global credit conditions to kind of get sort of shaky.
Order cancelled.
Things are not looking great right now. But here's the point
Order
that I want to
partially
make.
filled.
Within this
Order
inflation
filled.
framework, 6.3%
Order
on the
partially
bottom,
filled.
8.5 in the middle, 10% on the top. If the Fed were to stop quantitative tightening because global credit conditions got out of control, or maybe there was a big default, somewhere inside the plumbing of the financial system, well, that's going to keep inflation on the high side. And why is that a problem? Well, because now you'll continue to have a reduction in corporate profits because inflation's going up, their cost of goods sold goes up, their cost of labor goes up, and as a result, profits decline. So you can either have the Fed cause a recession or you can have inflation cause a recession. Pick which one you want. But the point here is that the Fed has no easy answer. The Fed is stuck in a box, and we don't believe there's anything the Fed can do to solve the problem that they've created by printing so much money. Even in the last 2 years, an extra $4 trillion went on the Fed balance sheet just in the last 2 years alone because of the pandemic. Now, the ECB has a similar challenge. David just described, the outrageous inflation rate in Germany.
Autofilled.
So, with the combination of nat gas prices, energy prices, all the side effects from the war in Ukraine that are wreaking havoc in the EU, does that mean that Christine Lagarde actually raises rates in Europe even further? I mean, she already went from negative 50 basis points to zero. To zero. And Germany had a 37% increase in inflation.
PPI.
PPI. Well, yeah, sorry. But the ECB has interest rates at zero. That boggles my mind. But the question is the ECB going to have to raise interest rates at their next meeting? Or are they going to not do anything? Well, that's going to allow inflation to continue to be a problem, right? And with no real way out. Now, let me just talk about Italy for 1 second, because David mentioned, somebody leaving the Eurozone or the Euro breaking up. I don't think the Euro is in danger of breaking up anytime soon, although that it would be and could be a longer term possibility. Longer term, I don't know, 2 years, 5 years, 10 years.
It's enough that political climate changes in Germany. And those changes, when they happen, they are quick.
Yeah, well, you know what? You don't necessarily need Germany, okay? Look at the political situation in Italy right now. You have Giorgia Meloni, who is head of the Brothers of Italy, and she is taking more and more share from Ligue and from a lot of the Five-Star movement. She's taking members from or followers from, and she's a socialist. She's in favor of gas price controls in Europe and in Italy. And other price controls. And she's in favor of continuing Italian government spending. Why is that a problem? Well, because a country like Italy wants to continue to spend money on social stuff, yet the ECB wants to stop buying bonds. The ECB wants to raise interest rates. Right? The ECB recently implemented a program called TPI, the Transmission Protection Instrument. What's that? That's a bond buying program, an emergency bond buying program that the ECB put into place in order to prevent interest rates in Italy from what they call fragmenting, meaning getting way out of whack relative to, let's say, France or Germany or Spain or whatever. So that means that this TPI program can buy Italian bonds. Well, here's the thing. The Germans might get pissed off, right? There's a German court case right now against the ECB because the Germans don't want the ECB buying bonds from any country and subsidizing their domestic spending. So here's what's going to happen. You're going to have spending in Italy, or at least the rhetoric of spending in Italy, butting heads up against the ECB and the TPI program. Now, which one's going to win? I have no idea, but I'm going to be sitting back with some popcorn and I want to watch that show because that's going to be an interesting show to watch. What does the ECB do with Italy? Italy is not Greece. Italy is huge. Greece is a pimple on an elephant's butt. If Italy, some way, somehow, decides that they might be better off outside of the euro, okay, that would be a global problem.
And
So we're
the
just gonna have to
reason
wait.
Italy might want to be outside of European Union because until ECB is printing money for them and buying their bonds, they're fine. But when this music ends, Italy might be
Order
better off
partially filled.
going through
Order
bankruptcy
filled.
because they will clean off their debt
Order
through
cancelled.
bankruptcy.
Yeah, and guess who owns most of their debt? The ECB. Okay, big freaking deal. That's the German credit card. Okay, thank you very much. So it's going to be interesting to see what eventually happens in this confrontation between Christine Lagarde and the ECB and the spending desires of Italy. Now, I think it could be a real problem if they don't bring Mario Draghi back as prime minister in Italy. Know why? Well, because Mario Draghi knows where all the bodies are buried. He's the guy that can bring everybody to the table and say, "Hey, cut the bullshit. All right, I know that game. I know this game. Be reasonable." But if he's out of the picture, there is no
Order
adult
partially
in the
filled.
room that can bring everybody
Order filled.
together and come to some reasonable compromise. And if they can't, if Italy and the ECB can't come to some reasonable compromise, it's going to be interesting to watch what
Order
happens, what
partially
the
filled.
fallout might be. Now, don't
Order
forget,
filled.
on September 25th, you
Order
got Italian
cancelled.
elections. So it's not that far away. Maybe they get a coalition, maybe they don't. I don't know. But Italy is definitely the country to watch in the Eurozone right now. So, David, unless you have
Order
any
partially
questions,
filled.
or unless any of our
Order filled.
anyone in our audience has some
Order
questions about
cancelled.
anything that's on their mind,
Order partially filled.
Yeah, notice Angelo's accent is this New York Italian accent, right? So that's why he knows so much about Italy.
how you doing?
Okay, so
So,
let me so let's give some
does
space
anyone,
for people to ask some questions if anybody has.
Pete, do you have anything you want to add? If you do, just unmute yourself. I think in order for them to unmute themselves, do they go back down to the bottom and click on the microphone icon? That should do it, right?
Yeah.
Yep. Just click it and it'll unmute.
Let's show everyone in the room.
Just so everyone knows, Pete is our, I'm going to
Order
call
filled.
Pete our resident
Order
energy
cancelled.
expert. Pete is keeping a close eye on what is going on with energy, the United States
Order
Strategic
partially
Petroleum
filled.
Reserve,
Order
how
filled.
much they're using
Order
of the
partially filled.
SPR, and when it's slated to end. And I posted something in the senior traders room this morning that the second it starts to get cold, a lot of people here in the US, like I use oil, I use heating oil. I'm expecting my heating oil bill to double this winter. Double. Nat gas, uh, that's an easy double as well for anyone that uses nat gas to heat their house. And that is going to be a similar problem in Europe as well. So, David, why am I bringing that up? Because that's going to have, I believe, a direct link to retail sales and consumer consumption. If you're currently spending double the price in order to keep your house warm,
Order
gasoline might
partially
drop a
filled.
dollar a gallon, but
Order filled.
that drop in gasoline
Order
prices is
cancelled.
not going to come anywhere near
Order partially filled.
covering the cost of how much your heating bill is going to be this winter. And so people won't be going to restaurants. They probably, I don't know, you might have to buy more long johns and socks and stuff because you're gonna be turning the thermostat down and your house is going to be freezing. But I'm expecting a decline in consumption as a result of the doubling of our heating bills this coming winter.
Order
Pete,
partially
anything
filled.
you want to say on that front if
Order
you're
filled.
with us?
Order cancelled.
Actually, I don't see Pete. I think no, I see Pete,
Yeah, I do too.
but he's muted, so I don't know if he's paying attention.
Order partially filled.
All right. So
Order
does
filled.
anyone have any questions? If you do, unmute yourself. Feel free to speak.
Okay, I think no questions. So,
Okay.
Angelo, thank you very much for the insights in inflation. Yeah, I mean, this bear rally that we have seen is huge. And
Yeah.
it's based on fairy tale that inflation is going down, Fed's gonna turn, we are going to reap new all-time highs. Recession, come on, that doesn't matter. We are in a new reality where stocks go only up, and that's
right.
what it is.
And David, I'm going to tell you something else. And one final thought. The narrative is also that, oil just went from $125 a barrel to today it's trading at $93. That's not enough. That's not enough to offset all of the other inflationary pressures in the other components that make up the
Order
CPI
partially filled.
and headline inflation.
Order filled.
It's just not.
Order cancelled.
And by the way, gasoline prices. Let's talk inflation again, just real quick. So in June, the inflation number here in the U.S. was 9.1. In June, it was 9.1. In July, it dropped to 8.5. That 0.6% decline, right? That's 60 basis points of decline. 59 basis points of that 60 was from the decline in gasoline prices. Well, guess what? Kramer, Mad Money, CNBC, Kramer gets up and he goes, oh, look, gasoline prices just declined. Consumers now have more money to spend. Well, you want to know something? Guess what happened to restaurant sales and traffic going into fast food, casual dining, and fine dining? Guess what? It all
Order
went
partially
down
filled.
and is continuing to decline.
Order filled.
That tells me that energy prices, haven't gone down anywhere near enough to offset the increases in all of the other things that affect our lives. Our property taxes are going to go up. Our insurance bills are going to go up. My homeowner's insurance. Pete was telling me that, he got a property tax bill and it went up 10%. Well, that's 10% on a big number.
Order partially filled.
Property taxes here in the
Order
U.S.,
filled.
they're in the thousands of dollars.
Order
I don't know
cancelled.
what they're like, David, in the Czech Republic or parts of
And
Europe.
I wanted to say too that that's next year's taxes, so that's next year's inflation, not this year.
Yeah. So if your property taxes are $5,000, your property tax bill's going up $500.
Order partially filled. Order filled.
And it's only going up. It's not like gasoline or oil that might go down a little bit. That's a permanent $500 increase.
Order partially filled.
So
Order filled.
So anyway, be careful of the storytelling on Wall Street, because right now, like David said, the storytelling is, oh, energy prices are coming down, so inflation's going to decline. No, that is not the math. The math is 6.3% with 0% month over month inflation between now and the end of the year. If you think that we're going to get something less than that, then that means there has to be actual deflation, David. In order for a number to come in below 6.3, we have to have actual deflation. I don't know about anyone else listening, but I don't see deflation anywhere in the cards anytime soon. So I expect inflation to stay solidly above 6.3.
Well, we will
I
have
think,
deflation once they manage to really destroy the economy. When the unemployment will really go down, when GDP goes down, 3 quarters in a row, then we will get a deflation.
yes, yes, but that'll take some time.
But that means, stocks being 20-30% lower, at least.
Absolutely,
Yeah.
absolutely. And just for historical perspective, ever since World War II, the average decline during a recession in the S&P 500 here in the US, so post World War II, the average decline in a recession here in the US is 40%. 40%. So I fully expect this recession to be equally as bad, if not worse, than 2007 to 2009. And that period, the S&P dropped 56%, folks. 56%. What do you think this is all going to look like if we drop even 40, 45%? It's going to be really ugly.
Yeah. And
So,
just to let you know, Angelo, that I don't know how it's in the States, but in Czech Republic, because investing is not very widespread, it's new to people because we had communism. So, it doesn't have any tradition. People don't really know how to do it. So you have all these local FinTwit gurus who are teaching people to invest by averaging down, the SPY and Bitcoin and all this shit. So people are on every dip, they are actually buying. They're buying more of Facebook. They are buying more of Netflix. They are buying more of this and that. And that's and now people are crying and because they are telling them, well, the drawdowns are just temporary, but then when people feel the drawdowns, actually they feel it, because in theory, on paper, drawdown, it's just a number, but the fucking reality is a reality, right?
yeah, unfortunately, the math doesn't work.
Yeah. So for those who are averaging down, they are gonna go to hell. I mean, they are gonna really regret this. And by the time this bear market is over, nobody will remember this averaging strategy anymore. It will be forgotten.
That is true. And by the way, the psychology at the bear market bottom is usually, I'm never going to own another stock again in my life. That's usually the psychology at the bottom. People get so disgusted that they don't want to have anything to do with it. But then again, the bear market will turn into a bull market, and the bull market will start to go up, and eventually, human nature being what it is, people will start to come around again because they'll have FOMO. Oh, stocks are going up. They were up 15% last year. Oh, stocks are up again this year. I guess I better start investing again. That's the way it works. Okay. So anyway, David, I hope that
I think
our listeners enjoyed this conversation. I hope they found this inflation framework useful so that they can use it and overlay it on whatever else they're using to, come to a better conclusion as to what their investment strategy should look like in the coming days, weeks, and months.
Okay. Thank you, Angelo, and have a good night.
See you later.
Ciao.